So, good morning. We're going to I'm going to talk for a minute while people filter in, because I don't say that much that's that interesting. We're delighted to welcome you to our first assignment talk of the year. And as has been the case for the last 2 years, our speaker today is Conor O'Toole. I think I say at the start of all these, and forgive me for those who've been at them before, really what the Simon Talks are had, but the genesis of them was this idea that we invest time in taking on board the ideas and understanding of the housing and homelessness problems from a wide variety of sources, and feed them through the understanding of the frontline services provided by the Simon Communities of Ireland and the experience of our service users and our staff and the member organisations. Through that, we then look to shift government policy to the sort of emphasis, both sort of prioritising homelessness, obviously, but emphasis on policies that are going to help us to drive down the number of people experiencing homelessness. The talks came out of an idea that there's a real value in the work that we appropriate or that we listen to and borrow, and we thought creating a platform that shared that would be something really useful. It also gives those who are interested the opportunity to see the difference between what Conor might say and what I might say Conor says. So today is, as I say, we're looking at what's on the horizon for Ireland's economy and what that means for housing. As Conor is going to speak, there'll be an opportunity for usually about 20-25 minutes, Conor. And then there'll be an opportunity for Q&A. If you have a question, do pop it into the Q&A or the chat box, and I'll ask Conor towards the end. Don't be afraid to just pop in the questions as we're going along, because as it comes to you, and if you want to put in 2 or 3 questions, absolutely, that's fine. But we'll deal with them once Conor has completed his talk. The other thing to say is that the Simon Talks, obviously anyone who's on social media, do use the hashtag Simon Talks, because that makes it easier for the guys who are in charge of Twitter to find you and retweet and that kind of thing. So with that, I'm going to quickly introduce, for those who don't know, I'm going to give a very quick introduction. So Dr. Conor O'Toole is an associate research professor at the ESRI, and he previously held positions with the central bank and a plethora of other organizations. For those who might be interested, there's a very comprehensive bio of Conor on the ESRI website, which I got exhausted just reading. So what it shows is that Conor has a huge experience in both the economic fiscal responsibility, banking, and housing policy. He's a regular contributor or producer of the RTB index, so he has a working knowledge of the policy and the drivers of housing in Ireland, and that's why he's such a valued colleague for us here in the Simon Communities. So with that, I'm going to hand over to Conor with thanks.
Thanks very much, Wayne, and thanks everybody for listening in this morning. So what I'm going to try and do, given that we've given this talk at this venue in the past, I think what it's nice to do is maybe try and take a big picture view on the outlook for the Irish economy, what the challenges that we might be facing coming into 2024, and then think a little bit more broadly about the housing situation, about the kind of general housing trends, and how we might see those develop over the coming year in particular. So what I'll try and do over the next half an hour or so is to give that macroeconomic overview, talk a little bit about the international economic conditions. There's huge uncertainty that has been persisting across the global economy for many years now, given the repeated shocks that we faced, from Brexit to the pandemic to the war in Ukraine, and now to the uncertainties in the Middle East. So there's a huge amount of volatility and uncertainty that we face, and as a small open economy like Ireland, we're extremely exposed to that. So we have to think about how does that affect us, and these events and that context might seem very far away, but as I said, as a small global economy with a huge multinational sector that provides a huge amount of public taxation revenue, that really matters for things like policy in the housing market, because obviously the revenues that we have available as a state to deploy into the housing market to deal with some of the constraints that we know are there can be very much dependent on that global situation, and in particular the multinationals. So I think it's always worth starting there. In terms of the housing market, I'll try and talk a little bit about the outlook for the typical stuff that we think about: house prices, rents, supply, some of the cost pressures, but also want to pose some questions in a longer term demographic context, and try and think about, as a housing system, what do we need to be delivering in terms of our broader housing market activity. So that's hopefully the plan for today. Okay, so let me start with the very big picture. And you can see the table there picks up the three key indicators for the Irish economy: GDP, which is the value of all goods and services produced here; GNP, which is a similar measure but takes away some of the profit outflows by the multinationals; and then modified domestic demand, which is our kind of typical measure of what's happening here domestically in Ireland. I guess last year was quite a quite a big year in national accounting terms, because we're likely to experience quite a big recession last year. Now, there's very specific reasons for that, because the domestic economy is actually still growing reasonably strongly, but the multinational sectors, in particular the exports of pharmaceuticals and some other multinational related exports, have been dropping quite sharply, and they have risen hugely over the past number of years. They really have bucked the international trend and have experienced growth rates that are not really seen at a national level in other countries. And that, what we're kind of observing now is a fallback of some of that increase. So it's not necessarily pointing to a weakness in the domestic underlying economy. Over and above that, we do have investment slowing as well to a certain extent. This is both in terms of the machinery equipment type investment, so there would be plant and machinery by firms, but also investment in the commercial real estate, the non-residential dwelling sector of the real estate. I'll touch on that. So that's the kind of bad news piece. What's the good news piece? Well, we have an extremely well-performing labour market. We really have a very robust labour market outcome continuing, and we see that persisting into this year. We're really at historical lows in terms of the unemployment rate, and that really is a major strength of the economy, but also in a context where we have had high inflation, and you've had that inflation being driven by energy prices or by some of the imported supply chain effects. A tight domestic labour market, the big risk is that can start to feed back in and add its own pressure to prices. That's still a risk that we see for the period ahead. As I mentioned, the multinational contribution to the public finances earlier on, our public finances are really in a very strong position on an aggregate level, but that is because there have been huge amount of receipts come through the corporation tax, but also, we have seen quite a bit of growth in the other indicators as well. So public finances remain strong, but there are notable risks in terms of the multinational activity. So that kind of explains where we got to for this year. For 2023. What do we think for this year? Well, actually what we see is kind of a normalization of activity this year. So with the domestic economy, there were signs it was starting to slow somewhat from that volatility coming out of the COVID period towards the end of this year. The high inflation rates affecting real incomes, tailoring back consumption patterns. All of this, was still growing robustly, but moderating, and we expect that to continue into 2024. And so where some of the more generalized weaknesses may be on the international side. I think it's very useful to try and picture this in some way, see the different divergent paths on what we have as really a dual economy in Ireland. The chart on the left-hand side here in the blue bar gives you the year-on-year growth rate in GDP. So you can see throughout 2023 that was declining. So the growth rate was coming down and falling towards the end of the year. Why is that happening? If you look on the chart on the right-hand side, what this does is it breaks out that output growth between the foreign-dominated sectors. So these are the sectors that are really dominated by the multinationals, and then the domestic-oriented sectors, which is the blue line. You can really see that this decline is materializing in the foreign sectors. You can see the orange line there dropping off cliff towards the end of the chart, but having grown astronomically in that period of 2020, 21, 22. So, in a sense, the drop is coming from a very high level. That blue line, the domestic economy, you can kind of see following the COVID period, 2020, 2021, that volatility, it has been stabilized, and then it has kind of normalized towards the end of that period. So that's the normalization that we're seeing in the domestic economy. Modified domestic demand, as I mentioned, that's our indicator of the strength of the domestic economy's activity. And what we've really seen over the past number of quarters is that has moderated quite notably. The latest figure that we have for the end of last year was it's dropping down towards 2%. So that's kind of in the more longer term range of growth rates for the domestic economy. I think it's always useful to try and break these figures down into their constituent components. What this chart does is it shows the various elements that we build into our output measure, our GDP measure: consumption, government spending, investment, exports, and imports. I also like this chart because what it does is it takes the first 3 quarters of last year, which is the data that we had at our previous commentary, and then it takes the very latest data point, which is Q3 of 2023. And in a sense, if the purple dot is lower than the red bar, it means you're getting slower, or your economy is performing less well, because the latest data point is slower than the full year picture. And what we can actually see is that in the investment side, in the exports, and in the imports, and the trading side, we're having that loss of momentum, whereas in consumption, which is the domestic spending, it's really holding up fine, as is government spending. So this again is this 2-tier structure to the domestic economy, and this matters for all of the way we think about how we set up our budgetary policy, how we support households, how we tie back into our choices around housing policy, because we need to think about if there are risks to our public finances, we want to deploy them as best we can. Well, we need to think about, well, how sustainable are those funds going to be if we get continued retrenchment in the multinational sector. So to focus back in then on the domestic spending, as I said, this is still performing reasonably well. We've consumption expenditure for the full year last year, just over 3%. But that's the kind of level that would be would be sought after by many economies across Europe. There's very few of them that achieve that level of growth in their consumption activity. Many of the big economies like Germany are actually are really struggling in that regard. They've declines in consumption. So we're performing reasonably well in that regard. But you can see, when you look at the chart on the right-hand side, which looks at retail sales, that blue bar being the overall retail sales, it is moderating, it is coming down. So that is pointing towards a slower growth rate for a domestic economy for 2024. And you can see we've moderated our forecast to 2.5%. What are the factors behind all of this? Obviously, the ongoing cost of living challenges have really squeezed household incomes over the past 24 months or so. That is likely to continue because the level of prices is remaining relatively high. We've had those interest rate increases. They affect obviously mortgage holders who are on variable rate mortgages, but they also affect the affordability of using consumer lending for purchases, and all of this affects the domestic expenditure. So all of these kind of headwinds pulling down the growth rate of domestic spending. I've mentioned a little bit the multinational activity, the big declines we've been noticing for last year. You can see the chart here looks at the trend in exports on a year-on-year basis, and breaks it up between goods, services, and overall. And you can see actually it's the goods side that's really pulling down the overall growth rate in exports. And what's happening there really is the pharmaceutical sector and some other big sectors are having a kind of a period of retrenchment following hugely high growth, and that is what's pulling down the overall export level, and that's why we're having a decline in exports. And that really matters for our GDP figure. That's what's driving down our GDP figure more than anything else. So I think that's a typical part of the story. At this point in time, we are not expecting this to be a sustained pattern. The data do not point necessarily allow us to make that inference at this point in time. We are expecting that to have been an adjustment based on some of these sectors' success during the COVID period, in particular around vaccines and the like. So we are expecting growth to return in the export side. But that said, this is something that needs to be watched very closely. I think it's always worth thinking about exports. We always think about exports. We think about what does Ireland sell. We think of, food and beverages and all the things we like that. But actually, half of our exports are either computer services or pharma exports. So, we are very highly concentrated in those two particular multinational sectors. Okay, let me talk a little bit about investment, because this does really matter for the housing market and for the housing activity. Investment has been coming down quite rapidly. There are some what we would call base effects happening here. There was a very large investment in 2022, which means that didn't occur again in 2023. So then it's coming down on the back of that. But even over and above that, we are seeing a slowdown in investment, and it's happening across the board. You can see the chart here shows a similar picture to the overall GDP components chart I showed here. For the very last quarter, the red dots, Q3, declines in overall investment, machinery and equipment, and the non-dwellings construction activity. So this is the commercial real estate activity. All of this is tipping back. The only one that we saw an increase in last year in terms of the asset structure were the residential dwellings, which were up notably for the first 3 quarters of the year. So investment is weak in that context. I talk about the bad stuff, so you have to talk about the good stuff. The labour market, again, as I said, is operating at capacity. We have an extremely low unemployment rate. We have still historically high vacancy rates. There's some evidence that the unemployment rate has maybe hit a plateau and has tipped up a little bit in the recent couple of data points, but we are still operating in a very, very rapidly growing, very robust labour market situation, and with continued options for people who lose their employment to be re-employed, which is good. The risk here is that in such a tight labour market, you can still have this challenge where tight labour markets lead to wage pressures, and that puts pressure on prices more generally, and that can feed back into inflationary effects. So that's still a risk here with such a tight labour market. But there is some evidence that has plateaued in terms of the labour market side. In terms of inflation, we saw an extremely high outturn for 2023, over 6%. We are expecting inflation to come down up to under 3% for next year. We're having these kind of dual effects. Some of the energy related items are beginning to come back, having grown really, really to a huge extent in the past 24 months. They're starting to tip back. But elements like food and beverages, recreation and culture, these elements are remaining relatively high, and that is kind of keeping the base level up. But we are expecting inflation to come back somewhat in 2024. I won't dwell on this too much. There's a huge amount in this material, but in a sense, I think the main element that we're thinking about what's driving down the inflation rate towards the end of this year has been that energy price moderation and the gas electricity price moderation that we've seen towards the end of last year and into this year. I think that's one of the main catalysts for that drop in the inflationary effects. In terms of the public finances, as I mentioned earlier, we have a extremely big surplus for this year. We're expecting, or for last year, we're expecting one for this year. So there are lots of funds. The difficulty really is that there's a huge component of this that has been estimated to be windfall. And this is a major risk if we're thinking about whether these are sustainable or whether they'll continue into the future. Because if we're trying to use these funds, deploy them into the economy, trying to look at where we can use them, if these are windfall and we tie them to current expenditure in particular, and they disappear, well, then that's a major challenge in terms of being able to continue that expenditure, that put pressure on the public finances. So these are really important questions around how do we deploy these windfall gains and whether the economy actually has the capacity at the moment to be able to take this additional stimulus. Okay, to maybe just summarize the economic position before I move on to the kind of outlook. How does this tie into the housing market? So we are experiencing a slower international picture that is specific to Ireland, in that it has been extremely rapid in Ireland, the drop in exports, but it is also in the context of slower international trade more broadly. That matters for Ireland because the multinationals are such a contributor to corporation tax. So if there's any fallback there, then that is a particular risk. On the domestic side, the economy is still operating robustly. We have a very well-performing labour market. We are expecting household spending to slow somewhat, and that may continue or become more rapid into this year. But given the unemployment rate where it is and the labour market's continued buoyancy, it is likely that the domestic economy will perform reasonably well into this year and beyond. Okay, so let me talk a little bit more specifically about the housing market and the housing outlook. I think we've said multiple times in the ESRI and in our quarterly commentary that one of the major challenges around the housing market is just being able to have a sufficient amount of investment in the residential sector to be able to deal with these well-known deficits and well-documented deficits in terms of the housing stock. And that's in particular the case around low-income housing, where we have a deficit in terms of the supply of social housing. The real challenge is trying to deploy too much investment into the sector at a time when we have an economy operating at full employment. So when you try and invest too much at a full employment context, what kind of happens is you get this rise in prices, and then you lose some of your investments. The economy just doesn't have the capacity to take that expenditure. So that is a real conundrum for an economy like Ireland operating at full capacity. We need to add to that huge demographic pressures that you're going to talk about. There is no slowdown in the additional need into the housing market every year. We are experiencing quite an increase in terms of the overall number of units that we need every year, and that's not going to stop anytime soon. In terms of the non-residential side, that's actually softening, and that may be a good thing in that we're able to divert resources in a capacity-constrained economy away from the non-residential construction towards the residential construction and build these units, which we know is a major constraint on the overall economy. So that's kind of where the elements I'm going to try and break down and talk a little bit more in detail about. Obviously, the counterweights to having more residential investment are the higher interest rates. That has definitely led to challenges. Material cost inflation is coming down, but the level of materials cost is still high. And obviously we've got skills shortages leading to wage cost pressures in the sector. So all of these are kind of counterweights to getting more from the output in terms of the sector. Okay, so let me talk a little bit more in terms of the how these kind of channels I've mentioned are going to affect the overall economic situation in the housing market. Let me first talk about the demographics, because I think in housing, everything comes back to demographics. It just comes back to the population size. You know, you can see, you know, the red bar here being the population in Ireland, about over 5 million, the total number of households increasing notably on the 2016 census, and then this really interesting line, which is the green bar here, which is the headship rate, which is the number of persons per household. And we can see that it's remaining extremely high into, you know, across the intercensal periods. This is really important because how many housing units you need, this headship number can turn your population into the number of housing units you need, with some other assumptions as well. And one of the interesting things for Ireland is we have a really high headship rate in compared to other comparable European countries. And, you know, a lot of that is to do with fertility. We've very high birth rates over the past number of years. But in other European countries, they've had a convergence over time in the headship rate. So if this headship rate comes down, what it actually means is we need more houses per unit of population. Okay, so there's fewer people in each housing unit. So that's something we need to think about going forward. I think it's also, when you're talking about the big picture in the housing market, we really need to think about tenure. I think it's you know, these discussions on the kind of optimal residential output kind of sometimes get bogged down in detail. Whereas if we take a picture back up at the overall housing structure, we can see the tenure structure in Ireland is really moving towards rental and away from a home ownership based society, which is what we had for many years. And in particular, this group here, which is the red bar, which is the other renter, that includes the PRS, we can see actually there's a much bigger increase in PRS tenancies over time, and that is one of the biggest changes we've had in the housing market over the period of the past 30 years or so. Where is this adjustment happening? Well, it's really adjusting at the younger age groups, right? This is a chart from a piece of work we did with the Pensions Council a number of years ago. And what you can see here is this is the percentage of homeowners by different age groups, okay, over time. And what we see with this bottom red bar is the proportion of homeowners under 34 has really fallen quite dramatically since 1987. But it has also dropped for older age groups, so 35 to 44. So these households are moving into the private rental sector in particular. So this is really the structural change behind our housing market. When we think about the short-term outlook, we need to think about the structural change, because that's really what contextualizes everything here. Okay, so let's bring it back to the present a little bit, and let's just think about our two key indicators, house prices and rents. You know, having had huge increases over the pandemic period, we've had a dramatic drop off in house prices in the year 2023 and going back into 2022. And actually, when you adjust for inflation, you can see the chart here has a blue bar, which is just the nominal house price growth, and the red bar is the real house prices. So this is just for inflation. Actually, throughout 2023, real house prices were declining in real terms. So that's an important caveat. And so house prices have been coming down in real terms throughout 2023. That can be, the level matters for affordability, but also the trajectory of the price growth matters for affordability. And so I think that's an important dynamic. On the right-hand side here, we have the trends in real and nominal rents. This comes from the CSO data. The real rents have been actually they've been steadying, coming down towards 1 to 2% in real terms, even though the actual nominal private rental figures are much higher. Now, we have to always caveat this. These data, which are in the CPI from the CSO, these come from a survey of asking rents, and a bit like the new tenancies rent in the RTB. So this isn't likely to be experienced by all the participants in the market. So, but it does show that there has been a stabilization in the rent levels in real terms, even if the rent price growth in nominal terms is remaining high for the asking rents. Yeah, I thought I'd bring this in just to maybe make that point. The RTB have published this new rent index using their annual registrations data, which looks at the existing tenancies. I think it's a hugely informative piece to enter into the discussion around the market. And what we can see there, the right-hand side, 3 columns have the standardized average rent for Q2 2023 for existing tenancies compared to the new tenancies, which is the left-hand side, 3 columns. The growth rates and levels are lower in the existing tenancies than the new tenancies. So there is a dynamic in the market where we have a much higher inflation when you're trying to enter that market relative to those who are sitting in tenancies in the market. So this is a kind of a different aspect of it that we can see now into the market. You can see that this just kind of gives a picture across the country of where the differences on the new tenancies on the left-hand side and the existing tenancies, in all counties, there does appear to be a difference between the existing and the new tenancies. So it's not just a Dublin issue or an urban issue. Okay, so what about supply? We had quite a big increase in supply for this year. For the first 3 quarters of the year, it was up by by over 8%. And, we are likely to get over 30,000 units for 2023. And our forecast is for a continued increase, marginal increase over to 30,000 units for 2024. But let's take a step back and think about this in a kind of longer term population adjusted context. The chart on the right-hand side here goes way back to the 1980s and looks at the number of ESB connections, which is our housing supply measure, per 1,000 persons of the population of the household forming age group, so 18 to 44. And you can see we are still producing a lot less housing per unit of the population than we did back in the 1980s. So we still need to ramp up this supply. This supply. I know we say that an awful lot, and the type of supply matters, but also we do just need more units given our population dynamics. Cost side, what's happening there, because there's always a lot of talk about viability and whether it is possible to build these units at affordable prices when we want new supply. Well, we have seen quite a lot of headwinds fighting against the supply. We've had materials inflation increasing. We've had rising interest rates. Both of these, if nothing else was happening, we'd expect these to be pulling supply back a little bit. But actually, we even though these headwinds are there, we have been increasing our supply, which is a good thing. You can see quite notably on the materials chart here on the left-hand side, in the past number of months, in particular since the start of 2023, we have seen a drop in the materials prices, and that's a good thing, because that should, even though the levels may be high, the inflation rates are moderating, and that should give a bit of more stability and security in terms of the supply. But what about affordability? We talk a lot about price levels. We talk a lot about where do we need supply? What type of supply do we need? Is it affordable? Why are there a lot less younger households entering home ownership? All of these big questions are being raised here. And one of the key things we need to just think about is affordability. And then colleagues of mine, Wendy Dish and Rachel Slaymaker, did a piece of work last year where they tried to compare Ireland to other countries in terms of how affordable the picture looked for housing costs. And what these two charts here present is the proportion of households paying more than 30% of their net income on housing cost across the income distribution. So the Q1 here, Q2, Q3, Q4 to Q5 goes from the lowest income households up to the highest income households. And what you can actually see is that overall, it's the middle of the income distribution that really has a higher proportion of affordability challenges in Ireland relative to other countries, and that not necessarily for the lowest income households. That may be a surprise to people, but actually for those households who are in the lowest income bracket and they are either in social housing or they are in the HAP program and they are paying a differential rent, then actually their rent is well suited to their income. So relative to other countries, these households are doing proportionally better off. So I think that's something we need to remember. Whereas further up the income distribution, you can see the renters on the right-hand side, Irish renters in the middle income and in the fourth income quintile are actually paying, are in a more challenging position than their European counterparts. So that's an interesting dynamic to think about. So that's why I think one of the things we need to think about the housing market, just before I conclude. I've probably gone over a little bit on my instructions from Wayne, but we'll stop now. One of the things I think we need to think about as well as trying to deal with the affordability crisis, which we do know is there, but I think we're moving a little bit from affordability more just to access, right? So we are for those particular lower income households who are in the social housing system, they are maybe on the HAP tenancy, and then actually for their incomes, you know, the affordability challenge isn't enough. The difficulty is access for those who can't get into that, and access at the margin for people we're trying to get into these situations. So that's why the composition of new supply really matters. So we need we need supply across the board. All supply is good, but in particular, we need supply targeted at the bottom half of the income distribution, more social housing and more affordable housing, which can really help access issues for these people trying to enter home ownership, or not home ownership, but enter the housing market at affordable rates, either in home ownership or in the rental sector. Okay, so let me conclude with a couple of points that I think are particularly important. Look, we are still operating in a well-performing economy. It is buoyant domestically, but there are rising international headwinds that are going to affect us. I haven't mentioned it much today, but the tensions in the Middle East are likely to be pose a major challenge in terms of international supply chains. In terms of the Irish economy, we are at capacity in that labour market, so it's really difficult to do a lot more investments. And then when we want to do investments, we really need to focus them in on where the elements that we can add to the productive capacity of the economy without increasing inflation. And so when we're doing the prioritization in particular around our investment plans, we need to think about how do we pick those type of activities which will both not necessarily lead to further inflation, help the productive capacity, and deal with these infrastructure bottlenecks. And I haven't even started talking about decarbonisation and the climate action agenda at all, but obviously that is something that's going to need an incredible amount of investment as we transition to a low carbon economy. So with that, I'll pass back to Wayne. I'm more than happy to try and take questions and comments.
Thanks for that, Conor. That was, as always, a tour de force, and I think the way you kind of married the sort of broader economic issues and then put them back into the housing, I think gives a really clear overall picture. So thank you very much for that. And we already have a couple of questions in, some very practical. What do you think, and I don't know if you're across this, so the current Part 5 stipulations, and I know they're shifting in 2026, but current Part 5 stipulations will have, do you think it'll have a significant impact on the supply of social affordable units, actual units?
Yeah, I haven't done any specific research on that myself. So I'd be loath to comment on very specific measures that I don't have evidence for. I think, look, I think it's very clear to me that for 30 to 40 years we've had an under provision of social housing. And I think that it may, you know, I think it's probably clear from that period that we just need a bigger, larger, more flexible social housing system that isn't necessarily reliant on market output to keep providing those units. So my my long-term view on the optimal provision of that lower, the kind of social housing, affordable housing, is that it's going to have to be provided regardless of what's happening in the market. So obviously the part 5 linked to market activity, that's one way. It is a, can be effective when market output is high, but we need this residential output to continue throughout the cycle, not just be part of the cycle. It needs to be, counter-cyclical or cyclical neutral in some ways. So I think actually just the direct activity of local authorities, AHBs, providers of that social housing is really going to be the main mechanism that we get our units up in that in that particular component of the market, rather than through the cyclically adjusted market activity.
So the next question is, cost rental is still a relatively minor tenure, but if when supply increases in the tenure, what do you think the overall impact on the rental sector will be?
Yeah, like I've always welcomed cost rental. I think it's a great addition to the Irish rental landscape. I think it's becoming particularly clear that we are going to have a greater proportion of renters in the market, and that's what part of the motivation for showing those longer term structural trends in terms of the tenure shares was really showing that there is a pivot away from home ownership. And that doesn't mean that we aren't able to increase the number of homeowners, but it does mean that it is likely that we're going to have a larger rental share in Ireland than we had in the past. I'm not saying we're going to turn into Austria or any of these countries with major rental sectors, but we are going to have a greater share. And I think cost rental is going to play a big role in that kind of middle component of the rental income distribution. It is going to be tricky because what does cost rental mean? Cost rental means that the rents are going to be set based on the production of the unit and the ongoing maintenance of the unit. Production costs are so high that when you actually plug those numbers in, that means that the rents that will come with those units initially will be high. So even though we have, it's not that cost rental is going to deliver majorly low rents relative to differential rents or those type of rents. But I think we will need a bigger component of that in the market. The benefit of that will be over time, for 10, 20 years, households that are in those rental contracts will have certainty around the inflation rate, and they'll be exposed only to increases that are linked to the maintenance and upkeep and ongoing activity of that building, rather than be exposed to market rental pricing. And I think that's a big benefit to the system.
So I'll ask in the order they came in, but there's a couple of questions here. One I was going to ask myself, which is, so the next question is with reference to the housing affordability, to Rachel's study that you put up, for those in HAP, are any additional top-ups being paid directly to the landlord, including the sum, or does that calculation simply look at the differential rent rate?
So that's a good question, and you're testing my knowledge of the silk definitions there. So
it doesn't count top-ups.
Yeah, so that would be my sense. Yeah. So it's a household survey. It's on the official rent in the rental contract and then the household income.
So that is, that's a growing issue in terms of thing. But I think the other data that you collected, which I think is really important, is the differential between existing tenancies and new tenancies, and that's where the HAP really lets us down under current HAP rates, because people are having to top up 200, 300, 400, 500 euro to get back into the system.
Yeah.
And obviously that stays with them.
You're talking about here the rental indicators, the RTB rental indicators, yeah.
Yeah, and that differentiates, because people who are on a HAP and have been on it for a number of years and in the system are not seeing that level of topping up.
Sure.
Sure. So just Derek throws a curveball at you that I was going to show as well. So how many housing completions do we actually need going forward? Is it 30,000, 40,000 or 50,000 or more?
So there's actually ongoing research on that being undertaken in the ESRI by my colleagues. I'm not involved in it, but it is ongoing. So I'm not going to comment on that at this point in time, because that research will be coming out in the first half of the year, I'm sure. So I think I'll wait till the research is published. I think it's very clear, like the current figure of 30,000, it's going to be north of that. All of the indicators are pointing towards that, right? The demographic pressures alone, we've had really strong natural increase, strong migration. All of these figures are pointing towards needing just more and more units in Ireland. So I think, of course, it'll be north of what's there already.
And from Derek as well, how do we build more without having a significant impact on inflation? I.e., how do we keep the overall cost of unit delivery down?
Yeah, that's the big conundrum, right? So partially what we'll have to do there when we're trying to get more units with the same amount of resources in a constrained environment, I think we'll just have to try and think differently about it. Are there productivity savings within the way we build housing that will allow us to reduce the cost of construction? That's certainly one. So think about modular housing, for example. I think one of the things we can also think about doing is now that we're trading off residential construction versus non-residential construction sector as a finite set of resources. If we think that the residential construction is our main constraint, well, then we need to target our resources there, and that's something we need to maybe think in the short to medium term about trying to deal with that bottleneck. It kind of ties in with the broader decarbonisation agenda that we have as well, because we've huge investments we're going to need to transition our economy away from fossil fuels, and part of that is going to be investment that we need, that is going to need resources from the construction sector as well. So there, I think what we need to think about is how do we make investments that have high import content. So rather than what investments do we do that take a lot of international capital. So for example, wind turbines, etc., all of that built abroad, installed here, so that is less of an impact if they're built and installed here. So I think we have to trade those off.
And there's an argument for doing that when it comes to housing as well, in terms of modern methods of construction, actually getting them built in Poland and bringing them in.
Exactly. If we can find ways to do this, I know it's a kind of a panacea, right, to say this. It's easy for us to say this, but that is how you deal with it, right? Because you have a finite set of domestic resources. If you need to trade that off, when you're making your choices, so you can trade resi versus non-resi. And then, but also you need to think about, can we bring in capital from abroad that doesn't take up domestic resources, and that can help from an inflationary perspective.
There's two more questions, and I do want to get them, but just as a follow-on from that, isn't that an opportunity, or so some of the analysis made, particularly by people in my sector and me, is that a lot of this windfalls that we're seeing in terms of the corporation tax, and this, in our view, is a good place to put those resources. So an opportunity in that you're putting in infrastructure and housing infrastructure and using those kind of additional billions we're getting for that.
Yeah. Well, I think it certainly is. It's one of the major constraints that we face, and you have to trade off whether you need recurring funds that can't be part of that windfall, but where there are investment needs, so capital expenditure, that's certainly a good use of those funds. You see the government has set up a number of different funds in the last budget. I think they're very, very welcome, and I think we can deploy some of that towards dealing with the infrastructural bottlenecks, housing being the biggest.
So you've touched on this slightly, but I suppose just to ask the question, do you have any expectation regarding future trends of international investment funds in the context of housing investments over the coming months and years, in terms of what you're seeing in the markets?
Yeah, it's a tricky one because we don't necessarily forecast the subcomponents of the market like that. We wouldn't go into whether particular capital comes from domestic sources or foreign sources. And I think with the the one of the challenges that I think is faced with international capital is just the rise in interest rates. It has been a huge shock to the system, for investment flows that were geared on, a low interest rate environment for a very long period of time. Now they're faced with an interest rate of 4.5%. That's a huge barrier to those additional flows. So I think that's, if we are seeing a moderation in the interest rate path, which we may not do for if the European inflation rates stay high, then there may be a pickup in that capital. But I think it is being challenged by those higher interest rates. So I think that'll be a major factor for that.
So I'll keep going. Just to say, Conor is biting through a cold and flu here, and he's doing it thoughtfully. So I'll keep firing questions at him until he collapses. Considering public spending is quite low, is it envisaged that public spending will increase to bring us in line with other European counterparts, such as Finland? I guess that's for the Minister for Finance to tell us, or expenditure, but just
well, I was going to say that that is really a political decision. What the extent to which an economy is oriented towards public spending and public investment relative to not. So the optimal level will be the choice of the politicians to decide. I think, obviously, what I've been saying today and what some of the publications I've been involved in of the past while I've been saying is that you may want to change the optimal level of public investment, but you can't do it quickly. You can't do it, immediately. There are trade-offs. You need to think about how do you manage those trade-offs. And, if you want more investment in capital, you want more public services. Well, in an economy at full employment, then you're going to have to think about how you do that, to take that context into consideration, because you can't do it too rapidly, or else you'll just get inflationary effects.
Okay. Derek has put in a question. There's actually just a follow-on question for you that I wanted to put to you as well. Just in terms of, because you also threw up that I think that really interesting slide around the demographics around housing, and some of those. One of the things that comes up is the aging at which people are getting into the housing system, and the sort of upper echelons of that is people who are still in the private rental market as they're getting older. Mm-hmm. And they're going to be reliant on state funding, assuming they don't have their own significant pensions. And I suppose that concern for us, because the assignment communities are starting to see an older and older demographic forced out of the private rental market and becoming at risk of homelessness. So I think managing that is, we have to plan for that. So I'm just wondering if you've put any thought or had any thinking around what the housing system should look like, in terms of, if we're saying that housing ownership rates are, broadly in line with European norms now, or maybe even still a little bit higher. My view, the expenditure you'd have to do to get that back up to 1990 rates probably isn't realistic, and certainly would be a huge, effort. But what is the breakdown of, if you were to look at it in terms of those percentages, where do we need to be in terms of social housing, private rented, and home ownership? What's the kind of, do you have a sense of an optimum, or a sense of benchmarks along that?
See, in a sense, they're the type of questions that are very hard to answer. Like, what's an optimal home ownership rate? There's so many political choices involved in that as well, and how you reorientate or orientate your system. But let me talk about the element you were mentioning there about the older renters in the PRS. We did a piece of work with the Pensions Council, which we published last year, which looked at how many households would be at risk of poverty as they age, and if they're exposed to having rental costs at market prices as they retire, and they face that income shock of retirement. Right, it's multiples of what we have there now, and I think it's very clear that when we talk about things like cost rental and social housing, those older households who are in the PRS, optimally they would be moving towards these other rental system or rental types or tenures within the rental system, which wouldn't expose them to those market prices as they retire. But I think even then, it is likely that there will have to be some sort of subsidy available for households in the future that maybe we haven't had in the past, where we relied on mortgage amortization to reduce your housing cost in line with your income shock. And so I think there is going to be a requirement for the state to help these households who find themselves in those circumstances as they retire.
So we'll have to increase even to stand still if you think about that cohort as needing that additional support.
Yeah, I think it is. See, there's a long time, as there is still time for these households to find a tenure which is more appropriate to their income structure as they retire. But I think it's an issue we haven't necessarily had to deal with in the past because of our higher amortization rates of mortgages and our home ownership based population.
So with that, I'll sneak in Derek's last question here. Are we simply trying to do too much at the same time in the housing market, i.e., are we trying to deliver a huge number of units and at the same time demand significant energy refit? Could less be more?
Yeah, I think it's going to be hugely challenging to meet all the targets, retrofit targets, plus all the new builds that we need. Like there are only so many resources we can deploy into the housing system at the same time. We're all pulling on the same pool of builders and tradespeople and the labor force that's required for that. So I think we will have choices, and it will take a lot of thought about how do we manage those choices, because we have to get the housing and we have to decarbonize the economy. So that's why we'll need to think strategically about how do we do that? What is the best deployment of resources that reduces carbon emissions but also allows us to get our economy, our housing stock up to the level that we need it. So big choices ahead.
Absolutely. I think that's a challenging but good way to finish up. So we're 2 minutes early, which I think is a record for the Simon Talks. So with that, I'm going to say huge thanks to Conor again for really the hours absolutely flown by, which I think speaks to the engaging nature of, as does the number of questions we got in. It's really great to see that level of engagement on such an important topic, and particularly we tend to think of economics as being dismal science, that kind of difficult to engage with, and I think your presentation makes it much easier to see the flows and engage with a really important topic. So thanks again for that. Thank you to everyone who attended. Just to say, this will go up on YouTube, so on our channel, so it's available to watch again or to share with friends and colleagues, should you wish. So with that, we'll close out. Thanks again, Conor, and we'll see you everyone soon.